literally you'd have to get 100%. Not 99, not 97, 100. Because as long as there's one Bitcoin or even a fraction of a Bitcoin in the hands of the independent nodes, then all that would happen if you canceled.
Hey guys, welcome back to Everyday Finance. In this video, Yusko discuss about Bitcoin and other crypto. According to Yusko, in order to achieve the desired outcome, it is necessary to obtain a perfect score of 100%. Any score below this threshold, even if it is 99 or 97, will not suffice. This is because even a single point below 100 can prevent the desired result from being achieved. Having Bitcoin, or even a fraction of a Bitcoin, in the possession of an individual if you were to cancel, the only outcome would be the removal of the nodes. When Max advises against investing in ETFs, he explains that they may not be the best option, Yusko going to take hold of them. Well, let's examine that situation. Let's consider the idea of BlackRock. The overall plan is to obtain it. We will discuss how the boomers can invest their money in this opportunity, and then we will explore the possibility of acquiring it. It seems that the voters who elected those individuals are the ones responsible for their positions. Yusko don't believe you would want to take their belongings. But let's proceed, shall we? It's important to clarify that the items in question are not being taken from the degens and individuals who possess them. They're taking the ledger from the boomers who are supporting the boomer rapper. But let's assume they actually did it. Let's consider a scenario where they have 1/3 of it, and they receive another 1/3 when a portion of Bitcoin vanishes. The remaining portion experiences an increase in value, and lots of things Yusko discuss, so please watch the video to end, and share this video, and subscribe our channel Everyday Finance. Thanks.
The 4-year cycle exists because of the halving, right? Halving embeds this natural proclivity for price to rise. Otherwise, the miners, who are integral to the success of the protocol, would find themselves in a pinch because their electricity costs and space costs are fixed. So long story short, you have this cycle, and the cycle is exacerbated by humans, like the people watching the show. And, there are investors, people who buy assets when they're below their fair value. There are traders who don't give a shit about fair value. They just like to trade movement. There are speculators, which are the other side of hedgers. Hedgers are people who produce things and have to sell, like the miners or oil producers. But then there are the gamblers, and the gamblers are the people who don't understand or really care. They just want number go up. And then they buy on leverage. And that's what pushes us to the crazy parabolic blow off top. And then
here yet
on the other side, fair value, we're nowhere close to the speculative top. This is fair value. Fair value, according to Tim's Metcalfe's Law model, and I've been using the Metcalfe's Law model since 2014. Metcalfe's Law is the definitive way of calculating the value of a network, any network, whether it's Amazon, whether it's Apple, whether it's Bitcoin. And so the Metcalfe's Law model said the fair value is about 52,000. Now I've been rounding it to 50 to make it easy. But when we were at 25, not that long ago, I was like, look, we're going to migrate slowly toward fair value of 50. And guess what? Here we are, almost up to the halving. But then what happens is the halving in previous cycles doubles the fair value. Well, what do you mean? Well, think about it. If the block rewards go down in half, the price has to adjust upward 100% to keep the revenues the same. Now, this time there's a subtle difference. So what I was saying before ordinals was that at the halving this year, now it's going to be April 8th, which is kind of a coincidence. That is a total solar eclipse, which I think is an interesting day to have the halving. But anyway, and so that 100K number was my base case, but then ordinals happened and transactions went up and transaction fees went up. So it's possible, and I'm still working on this part. It's possible that fair value only goes to 75 or 80. Let's just say 75. So then the investors have been buying all this time up to fair value. Okay. Well, now we have new people. We have traders, we have speculators because the hedgers are selling. The gamblers haven't even showed up yet. Once they show up and once the leverage starts, then we go right through fair value. So right past 75. Probably in history, we go to 2.3x.
I was going to say we more than doubled it. Yeah.
Yeah, at the peak. We go to 2.3x at the peak. So we went to 69 on a fair value of 30 or 68. And so I don't think we'll go 2.3 times because I think there's less leverage. I think we go 2 times fair value. That's 150. So sometime between Thanksgiving this year and June of the following year, that's when we see the new all-time high, and then then we'll have another crash. And you tweet about this, right? And then get prepared, right? That we will go past fair value, and we will then have people come in and say, okay, I need to be short this, and the cycle will start all over again. And that's fine.
According to Mark Yusko, there is a 4-year cycle that occurs naturally due to certain factors. The tendency for prices to increase is closely tied to the crucial role of miners. Those who are interested in understanding the success of the protocol might face some challenges due to high electricity and space costs. Yusko clarified the situation for Hour. There is a cycle that is worsened by human activity, specifically by people while watching the show. It's interesting to observe the presence of investors who strategically purchase assets when they are priced below their fair value. There are traders who are solely focused on trading movement rather than considering fair value. These individuals are often referred to as speculators on the flip side. There are hedgers who take a different approach. Hedgers are individuals who engage in the production of goods and subsequently sell them, similar to miners and oil producers. There are also individuals who engage in gambling. These individuals are commonly referred to as gamblers for those who may not fully grasp or have a strong interest. Their primary focus is on seeing the numbers rise before making a purchase. Let's discuss the concept of leverage and how it contributes to the rapid and extreme rise in prices, leading to a potential market bubble on the other hand. Mark Yusko understand that you're concerned about the delay in receiving the item. It seems like you're about to mention Yusko's perspective on this issue. However, it's worth noting that this has been a common occurrence in recent purchases. It's fascinating to see how the build-up in leverage has impacted the fair value. This is nowhere near the speculative top. It is fair value based on Tim's Metap's law model. Yusko has been utilizing this model for quite some time. The 2014 Metap's law is considered the most accurate method for determining the worth of a network. Could you please provide an explanation about networks? Let's discuss Amazon. Let's discuss whether it's Apple. Let's discuss Bitcoin. So let's back to the Mark Yusko interview.
Literally, you'd have to get 100%. Not 99, not 97, 100. Because as long as there's one Bitcoin, or even a fraction of a Bitcoin, in the hands of the independent nodes, then all that would happen if you canceled the, Max, and look, I love Max and Stacy. I love them. They're great. But when Max says, don't do the ETFs because they're just going to seize them. I'm like, well, okay. So let's pull that thread. Let's say BlackRock et al., the plan is to get the boomers to put their money in this thing, and then we're going to steal it from them. Those are the voters that put those people in. So I don't think you would want to steal their stuff, but okay. Let's say, because they're not stealing the stuff from the degens and the people who have it on their ledger. They're stealing it from the boomers who are putting the boomer wrapper. But okay, let's say they did that. what happens? Well, let's say they had a third of it. Let's say they get a third of the Bitcoin. So a third of the Bitcoin disappears. The other 2/3 goes up in value.
Yeah.
That's a bad plan. So unless somehow you can get all of it, and here's the other reason I don't fear this, because when I first got into this back in 2013, and I was talking to Dan Moorhead, and he was trying to convince me, and I make the joke, which is not a joke. I was not running drugs on Silk Road. I was not a cryptography student. The first time he said the word Bitcoin to me, I was like, I don't really understand. I mean, tell me more. And he's like, well, it's infrastructure and it's this, new form of money. And I'm like, okay, tell me more. And it took me a while, but I eventually got it. But I remember Googling, saying, I'm gonna do some work. And if you Google Satoshi Nakamoto, what comes up is Intelligence Central, because Nakamoto is the surname of the families from the central region, central provinces of Japan, and Satoshi means intelligence. I'm like, whoa. That's too close to CIA. So I worked up this whole thing about they had a backdoor, right? They put a backdoor in it, they created this, and then they're going to steal all the money. And you go, well, why would they do that? Well, if you could take shitty money, dollars, and convert it into good money, Bitcoin, and then steal them, that's a good plan. So Scott Stornetta, who is a venture partner of ours, Scott invented the word blockchain. He and his partner, Stuart Haber, literally invented the word blockchain. And he's a pretty smart guy. He's forgotten more about blockchain and AI than I'll ever know. Cryptography, he's a cryptographic expert. And so I said to him one day, I said, do you think this could happen? And this fast said, no. Like, what do you mean? What do you mean? Like, you thought about it for like 5 seconds. And he says, well, here's the thing. The way you're thinking about a backdoor cannot exist in Bitcoin because it's air gapped. Like, okay. So, but then just as fast, he said, but ETH, yeah, it could happen on ETH. I'm like, whoa. That was really interesting.
Mark Yusko discusses the importance of diversifying your portfolio by allocating a small percentage of your assets. This strategy can be highly effective in achieving diversification. Provide a brief overview of the background and origins of assets. Yusko can actually support that claim with data. It is considered the best asset for diversification purposes. It's important to have a diversified portfolio. Remember, concentrated portfolios may not necessarily make you rich. Portfolios that are diversified. Mark Yusko's entire career has been focused on ensuring your financial success. Up until the past 5 years, the individual was involved in the business of staying wealthy. Attracting affluent individuals and institutions, they explain to us how to keep ourselves financially secure by having a diversified portfolio investing with a focus on long-term growth and a preference for equity-based assets, emphasizing venture capital and innovation as an asset class. The portfolio is well diversified with high volatility assets. Over the past 15 years, Bitcoin has emerged as an asset with the highest volatility and the lowest correlation to other assets, making it unique in the world. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.